So today for Goals Question Time, I've got the pleasure of being joined by Gina Domanig from Emerald Technology Ventures. Hi, Gina.
Hey Andrew, how are you?
Very good, thanks. Very pleased to have you with me. I've been in the corporate venturing space for 25 years and working with corporates and how they do venturing and strategic innovation. And I think for most of that time, Emerald has been around, and I've been a great advocate for, your model of getting corporates involved as LPs and that within a fund. So I'm delighted to be able to speak to you after we were on a panel together recently. So good to have you here. So would you mind kicking off by giving us an introduction to yourself and Emerald, please?
Sure. Yeah, so I started up with Emerald about almost 25 years ago now. We were a first-time team, first-time fund in a sector that did not exist. So we were quite lucky back in the days to be able to raise our first fund. So we've been investing in climate tech, industrial tech since the very beginning, investing globally and in companies that are in early commercialization. So our first two funds many moons ago were quite early stage, lots of risk. We decided over time to move a little bit closer to commercialization, and that's, as you hear, a lot more relevant for our LP base as well. Today we manage about four funds and active funds and three mandates that we've got for corporates. It's about 700 million euro. We manage mostly money from industrial corporations, so over 50 industrial corporations that join our fund as limited partners, really for open innovation purposes. And I've got about almost 60 employees now in offices in Zurich, Toronto, and Singapore, and one in Tokyo as well. As you can imagine, investing in the sector needs a lot of technical competence as well. And so a lot of my colleagues are actually coming from those sectors that we invest in and have deep technology understanding as well.
Excellent. Oh, it's a great overview. Great overview. So what I'd like us to do in this interview is to really go through the sort of structure that was in my book that I published going on about 7 years ago now, which is called Purpose to Performance. So the first P is really around the purpose and the strategic objective. Be good to understand what is that purpose for Emerald and also for the corporate partners that invest in that in you, please.
Sure. So I should perhaps mention that before I started Emerald, I was 10 years working at an industrial technology company running strategy and M&A in the 90s. And in the course of that, kind of strategic work, we were doing a lot of scenario analysis. And our hypothesis back then was that sustainability trends are going to have a major impact on industrial sectors, both bringing new opportunities, but also challenges. Obviously, we were a little bit early for that thought, but when I left, I then decided to start up a venture capital fund that would be focused on exactly that, sustainability solutions for industrial sectors. And over the years, then we realized that the corporates were getting more and more serious about their climate commitments, so reducing their environmental footprint, but also, if you like, adjusting their own core businesses to be more aligned with sustainability trends. So wanting to pick up on those opportunities as well and mitigate some of the risks of being highly exposed to those sectors that are going to be under increasing pressure from climate change. And so that was kind of the hypothesis. Over time. It led to the point that today, almost all of our investors are those industrial corporations. And really, their purpose of investing in our fund is obviously they would like to get attractive financial returns, but the primary purpose is to find solutions. They're very often early adopters, so customers to some of these startups, partners. Occasionally, they acquire the startups as well. But I think that's really, they're looking for solutions to their climate-related problems.
Yeah. No, I agree with you on that as well. And I was seeing similar things in the late 90s and the early 2000s, and that's why I got into this. how do corporates take technology and change their business models and change the value chains they're going to be in, and that's particularly important with sustainability. We've seen in that over the years. So could you give us some insight into the process, your venture fund process? How do you get LPs to commit their capital and that into you? How do you find ventures, and how do you invest? And then if the corporates invest alongside, if you could give us an insight to that process.
So how we first, maybe starting with the LPs, limited corporates take a long time to actually decide to make an investment. We often say that our sales cycle is something like 2 years,
Yeah.
right? So so it is important that we get to know them early on in their process. We help to educate them. We connect them to others within our ecosystem to help them to really build their case internally about whether they should be doing open innovation. Should it include corporate venturing? Should that corporate venturing then include making fund investments? And so we're very, happy to help them along that journey because we realize that you do need to invest in seeding that group, right? So we go to different events, Global Corporate Venturing, which we've run into you several times, obviously. And a few other key events where you tend to find CTOs, head of corporate development, and obviously those who have CVC units, those colleagues as well. So that's typically where we find limited partners. And of course, these industrial corporates talk to each other as well. So very often they come to us by word of mouth, where they've heard about us from one of our existing limited partners. The deal flow side is about it's about a third, a third, a third. So a third comes to us directly from the startups, and we've been around for a long time, so it's not that hard for startups to Google us. And about a third comes from our network, other VC funds that we've worked with, sometimes from our limited partners. And a third is actually proactively scouted. So I mentioned my technical colleagues, they have a certain hypothesis about opportunities within their sectors, and they go out and they scout for those deals. So that's kind of how we get to our deal flow. The process, Emerald is very kind of technology focused and built in technology. And I realize that for a lot of startups, we seem to be kind of very, very thorough and perhaps taking a little bit longer than what they would like to make our investment decisions. But we do spend a lot of time doing the due diligence, understanding not just does the technology work, but what is the market demand for that technology? How can we help the company? We very rarely will invest in a company that we don't think that we can add much value other than just money, right? So we're trying to figure out, who do we know? How can we help them? And even in the course of the due diligence, we already then start to introduce them, particularly to corporates that we think that could be of interest to them. And those corporates, going back to the topic of co-investing, a lot of times our limited partners do co-invest with us. So that's been the biggest change probably in the past 20, 25 years. When we started, first of all, there weren't very many large funds in our sector, and we were all independents, right? Everybody kind of scraping together their pennies, if you like, to get these financing rounds together, where today, in almost every investment that we make, there's at least one corporate that's co-investing with us, right? So we do very much like to syndicate with, ideally 4, makes a nice syndicate, kind of mitigate some of the risks of people falling out for follow-on rounds. But yeah, very often they are corporates. And I think a lot of the corporates have figured out how to coexist with the independent VCs in this world.
Yeah. No, it's a great overview to the process. And I go back to one of your first points there. I think an important role that you've provided in the ecosystem for years is that education and that bringing up to speed the individuals within the organization and all that. And I certainly found that when I was running the Corporate Venturing Academy to get people up to speed and that in those areas, which probably takes us on to my middle P in my purpose to performance is people. Yeah, how are you finding now the, bringing the skills up in the corporates for them to be able to understand how to interact with startups, how to interact with you as the financial investor, and whether you sit on the boards of these startups and whether the corporates sit on the boards and that as well. What's your view on the people aspect of doing all of
Yeah,
this?
that's super important, right? I mean, everything kind of either, either they're successful or they're not because of the people that are involved. We're very much on the line of make sure that the corporate venturing team has strong relationships within the business units. Ultimately, corporates are investing in order to have some impact on their business. Otherwise, if it was just simply for financial investments, then I'm sure their treasury department can take care of that as well. But if they're going to have a corporate venturing team, I would say if they, even if in the short term they're not being told they have to have an impact on the business, to survive, as you know, over the long term through different CEOs and different economic cycles, they need to be able to demonstrate that they're having a positive impact on the businesses. So if those, and the only way these startups will have an impact is if the corporate business engages with them, let's say doing a pilot or some kind of a trial. And if the corporate venturing team doesn't have the relationships with those business units, they're not going to be able to convince them to actually, dedicate, invest their time and effort in that. And we've seen so many different models of how corporates try to get over this challenge of the hesitancy of the business units, because of course they're very much focused on meeting their quarterly quotas and whatnot, to get them to focus on some of the longer term impacts. So that to us is super important, that those people, we can teach them the venture capital skills, right? I mean, they co-invest with them. They're one of our LPs. They co-invest with them. We'll make sure that nothing bad happens to them
Yeah,
on
yeah.
the VC side, but we cannot replace those relationships that they are hopefully bringing to the table. And as far as when they do co-invest with us, I often advise them to not take board seats, take an observer seat. Because what you really want is information and relationships. You don't want to have to be dealing with, ESOP vesting, governance issues, coordinating the next financing round. There's a lot of responsibility and liability that goes with being a full board member. And if the corporates can get the same benefit that they want, that they're looking for, without having to take on all that additional work, I think they'd be better served just being observers. But of course, then they have to make sure that whoever is on the board is also kind of aligned with that.
Yeah.
And so obviously, if it's one of our own LPs, that's an easy, but we also co-invest with a lot of other corporates that are not LPs.
Yeah, I certainly remember back from running the academy that normally I do the bit around the people, and whether you're on the board or not, just before a coffee break. Because when the people from the corporates, when I tell them they realize that being on a board has got fiduciary duties and they're personally liable. There's generally a shock, and they have to phone up their legal departments and say, I didn't know I was signing up to this. What's our policy on it? And it's like, oh, they didn't realize that because it's not covered by the big corporate parent anymore. They're personally on the board of
Right.
the startup.
Right. And also, I think, corporates tend to be investing globally, right? So they have to become familiar with all these different jurisdictions. And as we know, liability is different, and how the board, should be acting in different situations varies from jurisdiction to jurisdiction. And if they are not aware of that, they're going to get caught, right? I mean, they're often, when companies start to get into trouble, and I say to them, well, have they done, their ABC analysis so that you're sure that you've got sufficient funds to do an orderly wind down? Their eyes get really wide and they're asking me, "What are you talking?" I'm thinking, well,
Yeah,
you don't
yeah.
want you don't be paying for that out of your bank account, right?
Yeah, no, that point about cash flows and stuff like that as well is another important point that's sort of picked up, and they don't sort of realize because they just realize, oh well, just cash is there, isn't it? Because I'm in a corporate, it's there in the thing. Whereas startups, as we know, it's a very different world going from cash
Right.
flow one thing to another. So within this ecosystem you talked about, Gina, who are the partners? What give us a bit more information in terms of how you work with other funds, how you work with the partners within this ecosystem, because I think that's
Mhm.
so important in that as well.
It is. It's super important. Obviously, if I look at kind of the different elements that we need on the deal flow side, obviously having strong relationships with, research institutes and universities, that goes without saying. Although a lot of times what's directly coming out of there is too early stage for us, but it's good for us to keep those companies kind of on our radar. But having relationships with other funds is super important. So many times people ask me, "Oh, who are your competitors?" And I said, they're colleagues, right? We're interdependent, right? So yes, there's every so often you might be pitching against each other for the same LP, but that's first of all that happens very rarely. You're much more likely to be looking at in co-investing, right? And so it is important that we trust each other, that we have experience working with each other. That's the best deals obviously are often the ones that colleagues of ours or friends of ours are investing in. We don't mind who's the lead or who's following. That's we don't get too hung up on that. We always want to be an active investor. If we think that there's no room for us to be active, it's probably not something that is a good fit for us. But we've got many investments over the years where the syndicate members are well-known VCs to us, people we've co-invested with in the past. And also, when you get to really know people is when bad things happen, right?
Yeah.
If it's only a good news story, it's hard to see kind of how they really are or how aligned you actually are. We had a case recently where it was when Silicon Valley Bank disaster, right?
Yeah.
And we had a really strong syndicate in one of our portfolio companies that we unfortunately found out had all of their money with Silicon Valley Bank. And then we all realized that only two of us were actually able to transfer funds within 48 hours. All of our colleagues had these really long processes. And interestingly enough, so obviously one was Emerald, but the other one was a corporate. And I was actually very surprised. I said, wow, out of everybody, I didn't think that you would be able to move that quickly. He said, no, that's the way our authority structure works. I can, if it's a follow on under a certain amount, I don't need to go all the way up to the board.
Yeah.
So that's great. I mean, that's when you really find out kind of who's a good co-investor for different reasons, structure of their fund, decision making, size of their fund, how they support or not their portfolio companies. So I think colleagues, whether they're independent VCs or corporate VCs, super important. I think that our industry probably could do a better job at better relationships with investment banks. Um, Most VCs don't have very much M&A experience, right? And in our sector, in the kind of climate tech, most of the exits, especially now, are trade sales.
Right. Yeah.
And I think that we all could do a much better job making sure that the investment bankers have our portfolio companies on their radar much earlier. So as they're talking to their potential clients or their clients being the corporates, they can kind of help us to soft market some of our portfolio companies.
Yeah.
So I do think that that's an area where we collectively could do a better job.
Yeah. No, great points you raised there. And this overlap, I think, between people and partners is so important that
Mhm.
I've seen over the years and advised people, in corporates as well, doing into the CVCs, sort of saying, look, you cannot you cannot do the types of things you can just like the corporate might have with a supplier, and it's, oh well, we're just going to change our terms, and we're a big corporate, and you're going to have to continue supplying us. So look, this ecosystem, if you renege on something or you do something bad, the rest of the colleagues and that in that ecosystem, the other VCs and the other CVCs and that will know that you've done that, and you won't be a trusted partner in that anymore.
Exactly, and this is a really important point, right? So we always tell the corporates as well, when you make your initial investment decision, already then earmark a certain amount of money for follow-ons, right? You cannot just drop a portfolio company like as if you're changing a pair of shoes, right? I mean, you know, I said there will be consequences. If you drop a portfolio company for no good reason, you just decide to sit on the sidelines. I said, and then they shouldn't be surprised why we have such, drastic pay-to-play clauses, right? Even pay-to-play clauses where it's not even a down round, because you see so often the corporate kind of decision making, they don't understand the consequences of not participating in a follow-on round. It's hugely damaging for a portfolio company to, for them to say that one of their, what they thought was major investor has decided not even participate at all in a follow-on round.
Yeah. No, I had one particular case that I was involved in because I was an investor and also worked with the corporate. That there was a change. There was a change of the leader of the corporate venture fund. They've moved from Europe to California. The new head of that group had a new strategy for the change, and a good tech business and that in the UK was doing a follow-on. And the corporate was sort of blocking it. It was like, well, okay, fair enough if you don't want to follow on, but don't block the investment. And it went to the stage that the venture capital fund that was investing wrote to the chairperson of the holding company and said, "Do you realize what your people and that are doing in the business?" Because it was just there was no sense could be made of why that head of the corporate venture unit was doing. Fair enough if your strategy has changed, which, as you said, has got implications for the startup, because the other investors say, well, why isn't company X following on? But then to block it and all that was just ridiculous. And all of that could, soon after, that corporate venture person and actually the chief executive of the whole of the operating company were no longer in roles now. Not saying it was because of that, but it was because just the turnover of people is so important, and that reputation is in this ecosystem when you're supporting ventures that could take 5, 10, 15 years to get to exit.
Exactly. And we do see that, we do need to adapt also our terms and conditions to the reality of having so many corporates co-investing with us, whether it's like the pay-to-play clause. It's also obviously being able to withhold information from investors if we think it's commercially sensitive, and their potential competitors or customers or whatnot. That also has been something we've included, and obviously having the caveat of not to be unreasonably withheld, right? We have to very often explain to people, look, first of all, as a board member, you must act in the best interests of this company. I don't care who pays your salary, right? Yeah. And if it's a shareholder vote thing, we'll put in a lot more this not to be unreasonably withheld, because in the past we could depend on the VCs to do what it makes economic sense, right? But with the corporates, it's not always the case, right?
Yeah. No, a really good point. And I think people don't understand that different roles have got different interests. Whether you're an employee, the founding CEO, whether you're a director, whether you're a shareholder, those roles have got different interests, and it just needs to be explicit when you're in board meetings or when you're discussing. So, well, okay, now I've got my board member hat on, and I think the company should do this. But as the shareholder, my parent company is not going to do a follow-on investment. It's those types of things. You need to be very clear on those different roles and interests.
And you see it already in the term sheets, right? A lot of the corporates, just by reading the term sheets that they issue, you can tell that they're not clear enough as far as how do they have to vote as a board member versus a shareholder, right? Yeah. So if it's something where you really just want to vote your own personal interest, that's got to be in the shareholder vote, right? It
Yeah.
can't be, and they think that they're going to be protected because they may even, have all these bells and whistles around governance at the board level. But when it comes to it, they're going to have to vote in the best interest of the company. And there are times where, we vote one way as a board member and another way as a shareholder, right? Yeah, that's the way fiduciary responsibility works, right?
Oh, fantastic, fantastic. And we've touched on it as we've gone through, but performance measures, how do you think you should be balancing, and the corporate should be balancing, the financial returns and the strategic insights and sort of stuff like that? And
Right.
what's your view on that?
So, we as a VC, we absolutely have to be focused on financial returns, right? If we don't have attractive financial returns, we will not be able to survive longer term. That being said, that's not the primary reason why the corporates invest in the fund, right? They'll benchmark us typically before they invest against other funds, and they'll look at the financial returns as a proxy of, do these guys know what they're doing, right? But in the end of the day, they need to come up with, we believe they need to come up with KPIs, which ensures their own survival within their organization. And a lot of times up front, when we're, a new CVC team, we're trying to push them to give us KPIs, right? And we ask them, well, what are your KPIs? And they almost feel like they're lucky that they don't have any. And I'm thinking, that's living dangerously, right? You seriously need to have KPIs. I think it's unfortunate that a lot of corporates believe that in making investments should be one of their KPIs, because that can't be, right? Anybody can make investments. It has to be, in the end of the day, the impact on the business unit. And I realize that's a much more difficult metric to have than just simply the number of investments that you made. But we push them to say, okay, how many collaborations or commercial arrangements or agreements do you have in place? That should be, if you need to make an investment in order to secure that commercial relationship, okay. Or if you feel that you need to have some additional insight that you're not going to get simply as a supplier or customer, okay. Obviously, if you potentially thinking about acquiring the company and getting more active in that part of the business or the value chain, I get it, right? But just simply making investments shouldn't be the metric. And again, when there's a CEO change, people are going to go, hey, who are these people and what are they doing with our money, right? So that's I think a kind of a dangerous metric to have. And I would just, I would really encourage them to think about how they're going to be convincing their colleagues internally that they are having a positive impact on the core business, because in the end of the day, that's what counts, right? That's their original reason for being, and in the end of the day, that should be how they're measured. And not, I also, have a colleague who was head of actually two different CVCs, and he, say, how many unicorns do you have in your portfolio? And I said, it doesn't count if you're the one who made them a unicorn. I mean, we can tomorrow we can make all of our own portfolio companies unicorns if we want.
No, I made that point to a corporate who's in your sort of sector actually, and they were appeared in one of the main press and sort of saying they were going to make 5 unicorns in the next 5 years, and I said, yeah, the way you do that is just keep buying more stock or less stock at higher valuations. That's how you get a unicorn, isn't it? It's like,
and even the really large corporate venturing units who have been around for decades. Typically, there's a part of such large corporations that even if they had all these great financial metrics, it's not even a rounding error for a huge company, right? So I think at the end of the day, they can't justify their existence based only on financial metrics. I do think they need to go back to the origin of why they exist, right? And I think that there's a certain danger of the the venture team kind of forgetting who they're serving, right? For
Yeah.
us, it's very clear who our customers are, right? They're our LPs. Obviously, we work very closely with our portfolio companies, and part of us becoming successful is making them successful. But in the end of the day, the people who pay our salaries are our LPs. And that's no different for CVC. The people who pay
Yeah.
their salaries
Yeah.
is the corporate and all the guys who are running the businesses that are contributing to the bottom line.
Yeah, yeah, and I think it's important. I think there's a few points there. One is you need a financial return, otherwise you don't stay strategic in that for long. Also, when I hear a corporate say, "Oh no, we're just strategic, not financial," I said, "Well, you're going to be sitting around the table with the chief executive, founder, and with the other funds that want a financial return. They do not want you around the table if you're not aligned to make a financial return." That's a key point. Your point, I think, is really important as well about having those KPIs of, is it to increase revenue? Is it to lower costs? Is it to improve their environmental impact, or sort of some of those types of metrics? There's one which I think is a lot less tangible, but I do think is important. It's what I term the Scout B scenario. So what I think there is that these people in the corporate venture units are like the scout bees who are going out and seeing sunflowers going out of flower and heathers coming into flower. So, one of the ventures I'm working with at the moment, it's a disruptive technology that's going to replace chemicals in cleaning,
Mm-hmm.
product. And it's got a solution, and that they're hard tech sort of type solution and a new process. And if you're coming back as the scout bee to your corporate chemicals business and saying, "Hey, look, there's this technology here which is going to totally disrupt our business and our business model," it's not just about improving how they can make their chemicals more efficiently. This could really disrupt it. I think, how do you get that communication to come back to the core business and say, "Well, okay, you want to invest in this business, but we don't see a home for it in our current business model." So how do you see those sort of types of strategic insights and that coming back and that into the organization? Because they're difficult to pin down on.
Yeah, this market intelligence, right?
Yeah.
But we do have some of the CVCs that we work with, we know that they get pulled into the strategy process internally. They're used kind of as the, tell us what's going out there in the market, even the stuff we don't want to hear, even stuff we're, and I think that there are those who are very much plugged in, and that's an earned position, right? They have obviously demonstrated to their colleagues that they have something to offer. They have insights to offer. Some of them will have like kind of they're almost like show and tell days, right? Where they invite other people from the business units, and they'll talk about startups that they've seen. They might invite startups. Internal communication is so important, right? I think that every CVC should have that on the, kind of the top of their list of, how am I going to make sure that we're successful and survive long term, is they need to do a lot of internal communication to communicate how, the knowledge that they're picking up that could be relevant for the business units. And also, M&A, some of them are very plugged in also to the M&A process, so they provide kind of a scouting function for M&A as well. But it is more difficult, I think, to measure, right? Like how. Oh, actually, we have one of our corporates. I know that they've got a metric that how many companies did we kind of find or engage with where our business units wanted to have a follow-up meeting, right? So maybe you don't end up investing, and maybe it doesn't lead to a commercial relationship, but it was relevant enough that the business unit guys took time to actually have a call or a meeting with the guys, right?
But the challenge there, Gina, isn't it? And that's why I use the analogy of the bees, because it's quite a biological, interactive type thing. It's the scout bees coming back and doing the waggle dance, as bees do in the hive, doing the waggle dance to the king bee or the queen bee, the board members, and saying, "Look, this thing is changing in that year, and you need to be aware of it." And I've seen it over so many years that corporate venture units have come back to the core business and said, "Look, I'm thinking of investing in this sector. Oh, no, 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 it's not
Not
relevant.
going to work. We tried it 20 years ago.
Second or third time they come back, and then one of the instances in one of the consumer goods businesses, you know, the finally the corporate acquired that business for $1 billion, and that's when $1 billion was worth $1 billion. It's like the corporate
Yeah.
venture unit had been showing them that for, you know, months and years in various rounds. It was, you finally listened to us, but now it's cost you $1 billion sort of
Yeah.
type thing. It's
Yeah,
like,
but again, it's how do they gain that influence internally, right?
yeah, no, it's a challenge. Yeah,
Yeah, it's a relationship building, be demonstrating that you're relevant, demonstrating that you actually know something. But I remember once talking to one of the corporates and telling them about a certain startup company, and they go, "Oh, that don't invest in Gina. That won't work. That will never work." I said, "Okay, that wasn't the question. It already works. They already have revenues, right?
yeah,
And
yeah,
they just don't want you." That's actually going back to purpose, right? That is actually, I think, a purpose or a function that corporate venturing can definitely play,
yeah,
is
yeah,
to force the guys in the businesses to face the reality of what is really going on out there,
yeah,
even
yeah,
if they never thought that that could happen, right?
yeah,
So this culture kind of keeping them more open-minded and bombarding them with information that maybe they don't want to believe is true. But that's, I think, a very
yeah,
important purpose, is
yeah,
the
yeah.
having a positive impact on the company culture.
No, that really takes us full circle. That does, which is in my model in the book. It's what's your purpose? How do you do the process? Who are the partners you work with? The performance measures, and that comes back to the purpose. And the middle P is the people.
Yeah,
How
yeah,
do you connect to your purpose? Have you got the right people to run the process? Have you got the right people who are going to engage with partners? And have they got the right performance metrics and that for them, for how they engage with the business, but also maybe how they're remunerated as well in terms of the performance of the measures. So, Gina, finally, just in terms of tech and that's out there at the moment, what's your what are you seeing in sustainability? What are you seeing in artificial intelligence? What's hot at the moment and what's not? What's your sort of feeling on
sure.
the
Sure.
thing?
Well, I think, so 50% of what we do is in the energy space, right? So there's still a lot going on around decarbonization, hard to abate areas, electrification, obviously not so much passenger vehicle, that's really no longer a venture space, but, sectors like marine electrification. I think that's, so in energy, there's still a lot of that happening. About, let's say, the products. But there's also a lot of software that's being implemented as well around grid stabilization, right? So as we have an increase of electrification, how can we ensure that we're using the energy as efficiently as possible, and also accessing storage capacity. So even kind of feel like almost micro storage. We're invested in an interesting company, Inspired, that does exactly that. So I think around the energy space, that's quite important. Water has always been important, will continue to be important. One of the big topics right now is obviously the whole PFAS issue, and the realization, I think, of the average person on the street about how dangerous the levels of PFAS in the water system are. So there's a lot of, I wouldn't say that there wasn't innovation before. There just wasn't the market demand. I think now you start to see the market demand picking up. So that's really important. Plastics, packaging, super important in our whole materials part of our business. And anything, obviously AI, not for the sake of AI, but applying AI to a lot of the industrial solutions to make them smarter, to make them faster, to make the assets that we do have more effective and more efficient. I think that is we've got a couple of AI specialists in my team who spend all day just kind of looking at the application of AI and these different solutions. So I think that's also super important. I'm hoping that the built environment becomes more important, but unfortunately, I think they don't feel yet under threat. So it's still difficult for us to invest in building technology, let's say energy efficiency for buildings, just because we don't find a really strong pull yet. But that will come as regulation gets threatened. I think the built environment, can't get away with being responsible for 40% of the emissions and never get called on the carpet. So I'm hoping that will be also a sector that we're going to see a lot of change in the future.
Gina, thank you so much. That's been fantastic catching up with you. Fantastic getting the overview of Emerald, and I think really a masterclass in how corporates and investors and startups should be engaging in that with funds. So thanks very much for your time.
Super. Thanks for having me. Thank you, Andrew.
Please subscribe for future interviews and give us a 5-star like. Thank you.